Harvey and Irma and the earthquakes. Southwest canceled 5,000 flights, and that reduced revenue by about $100 million in the third quarter. So we'll talk to him more about that in just a few moments.
All right, let's get you caught up on the markets at this hour as earnings continue to pour in. Joining us for that is Michael Tyler, Chief Investment Officer at Eastern Bank Wealth Management, and here on set, Hans Olsen, Global Head of Investment Strategy for the Wealth and Investment Management business at Stifel. Hans, I'll start off with you. We were just talking about the market action yesterday, and at the lows of the session, it did look like we were going to see, you know, easily 1% declines or greater.
Right.
And what seemed to be behind that were interest. I mean, we had a number of idiosyncratic bad earnings stories,
right,
but we also had the 10-year yield hitting 2.475%.
Right.
So was that a glimpse of what the markets could be like if we do, in fact, see higher rates?
Sure. I mean, maybe it's a return to normal. You know, I was looking at the inter-year declines over the last 20 years, and it's not unusual at all to see intra-year declines of 8 to 15%. So if we just return to normal, we could see something like that, and would any of us be surprised at the end of the day? I think when you add, if we return to normal and then you add in perhaps global synchronous increasing or normalization of interest rates, we could have some rough air ahead of us.
Yeah. Michael, you know what was interesting in yesterday's sessions? We saw pressure on the financials, and in a rising rate environment, you think the financials would do okay. Granted, the 2-year yield did go to levels we haven't seen since '08, but overall the yield curve was effectively the same steepness. So what do you think was behind that, and should you be cautious given that cue that we were getting from the financials yesterday?
No, I think that the yield, the 10-year yield is likely to rise somewhat, and we'll learn a lot more about that a little later this morning when Mario Draghi gives his talk, because I think it's really foreign interest rates that are holding down U.S. rates right now. The U.S. economy can stand much higher rates, and you know, if you look at the Taylor rule or other potential ways of looking at interest rates, the economy can stand higher rates, both short and longer term. The question is, and frankly, if the yield curve steepens a bit because the Europeans start to slow down their bond purchases, that would actually help the banks. What would not help the banks and the financial stocks in general is for the yield curve to flatten out. And I think that's what the fear that started creeping into the market yesterday.
So a hawkish Mario Draghi later this morning would signal to you that that would be a good condition in terms of yield curve for the financials, and we would see higher rates here in the U.S.
That would be, and that would allow the overall level of rates to rise without threatening an inverted curve. That would suggest that the U.S. economy is still strong, can stand that very nicely, and we are in a great position here in terms of earnings growth. We've had very few earnings surprises, negative surprises this quarter. Earnings are shaping up well. The labor force is in great shape, comparatively speaking. We have record job openings, so there's no question that the economy can withstand higher rates. And what's kept it down is, hey, a 2.5% 10-year in the U.S. is still dirt cheap compared to a 0 in Japan or 50 basis points in Germany.
Given this environment, and we will be getting a lot of major tech earnings starting this evening, Hans, should investors start thinking about being more in the cyclical sort of sectors, the industrials, for instance, or industrials, the new growth stocks? Technology, you know, the price action in tech has not been great over the past 7 sessions or so.
Yeah. Well, I think if you cast it even in a larger light, if you start to pivot more toward a late cycle type of investing, so you're thinking about more value stocks at this point, whether it's financial, as Michael says, energy, maybe some of the industrials, definitely at that, I think we're at the point in the cycle where this starts to make a lot of sense.
And Michael, overall, in terms of the markets, you think they go higher here into year end?
I think we're going to continue to drift higher. There's nothing that's really going to push us down. If you look at the economic indicators, if you look at the technical indicators, and if you look at cash coming into the market, there has been this year an outflow of cash, but that's coming back as more and more people start getting their holiday bonuses. So I think we're going to continue to melt up into year end. And by the way, this is shaping up to be the first year in history without a single down month. We've had 11 straight up months so far. I think that suggests that maybe, as you said earlier, we might be in for a short dip here and there. That's okay. Longer term, I think there's no reason to stop the market as long as the earnings keep coming through.
It scares me when I hear somebody say on TV, I can see no reason why the market should go lower from here. Hans?
It scares me to say that.
Right? I mean, does it when it exited your mouth, where you're saying, "Oh, why did I say that?" I mean, it sounds crazy.
But on the other hand, you look at what the problems could be. The earnings are really solid. And, you know, we're at 19 times earnings. We're at a 2% yield. That's still well within one standard deviation of what normal valuation is. Stocks are not expensive right now. They're maybe a tiny bit, but they're not really expensive. Bonds are outrageously expensive, and that's what's causing people to worry about maybe we're in for a problem if the bond market tumbles, which it won't, unless Draghi says something really hawkish. If the bond market holds in there, then stocks are going to continue to melt up.
Last word, Hans.
I'm rooting for Michael, for sure,
Yeah.
on this, without a doubt. But I worry that the earnings comps going forward are going to be
Tougher.
more difficult.
Yeah.
Yeah, that'd be much worse than if the earnings comps going backwards were, because we already know those.
Well, we all.
Yeah, well, I know, because the future's much harder to predict than the
It's a
past.
foreign country.
Yeah.
Hans, Michael, thank you.
I want to know what's going to happen at the beginning of the day sometime, but I don't know if we ever will know that. Do you? Because I don't think
Well, at the
we're ever
end of
going to
the
know what
day,
happens at the
maybe
beginning
not.
of the day. Yeah. Okay.
Thanks, guys. When we come back, earnings alert for you. We're going to dig through those numbers from Southwest Airlines with CEO Gary Kelly. He will join us.